Good morning, folks. How are you? Wicked good. Thank you for asking. All right. I think it's the first time I got more than 5.5 hours consecutive sleep in a long time. I needed that. Usually I don't get too tired, and broken sleep patterns is the normal for me, but I've actually had to work the last week and a half. So, looking at today's calendar, we have a few things on our menu for concern. The 7 o'clock hour will be impacted with a minimum bid rate for the euro, so we'll be watching that. Um, we'll take a break after that initial injection of volatility for that report, and then we'll come back about 20 minutes after 8 for the CAD and the effects of that. And then we're going to have one more session. I'll come back on about 15 minutes before 11 New York time, and we'll watch CAD again as it relates to the crude oil inventory. So Canadian dollar is going to have some movement today. Um, I'm not saying we're going to be taking any trades in that, but we may do some exercises, but we're certainly going to be referring to where the liquidity is and do the drills that we've been doing since we started the sessions for this month. If you have noticed, I tried a new feature that I learned last night on the forum, and it's a password that I can change and rotate for each individual category. So since nothing was really time sensitive, I tried to see if you guys had access to get to it or not. If you can't get to it and you don't know and you can't follow along on the Twitter because of work or whatever, and you're here sneaking, the password for the category to get into that folder is capital E Enigma number 9, and that'll give you access to that. I'm probably going to take that off when we're done with this one session, just to remove the confusion. But I was just testing it to see if it would work, and it does. So I'm very pleased with that. Yeah, it's on Twitter. I tweeted the password. Most of them are probably already signing in now because I got about 400 people in here now, so they're probably here. No, you're allowed on the forum. This is I just testing a password feature that I didn't know I had. I can lock down individual categories. So, but the password is Enigma 9. It's capital ENIGMA number 9. It's just the mentorship ones. But I'm gonna, like I said, yeah, I'm gonna get on with this one real quick and get set up, and then we'll be able to right here. Last night, before I go through the charts, those that are following along on Twitter, we had a report due for the Australian dollar at 9:30 in New York time. That was out here, the trade balance. And again, I don't concern myself with the numbers over here, but being a high impact uh, report, I was expecting a little bit more volatility, but nonetheless, what direction or what liquidity, I should say it like that, what liquidity did we announce on Twitter would be ran on the Australian dollar? Okay, I'm not sure if you checked your Australian dollar chart this morning, but where did it go today? Okay. All right, so we're going to take a look at the Australian dollar. Okay, so we see last night, ahead of the release, market was in consolidation in equilibrium. Okay, all in here, all this is equilibrium. Let me get this thing out of the way. Okay, so we have market in a big consolidation, not really big, but a long, prolonged contraction. And in the middle of that contraction, between the high and the low, okay, the market was hanging around there right around the time of the release. Okay, so when we see that, what we're going to be looking for is expansion, but you need to understand what direction that's going to be based on the liquidity. So if we go out to a daily chart, let's zoom in. Okay, we have all the bodies of the candles in here, the wicks, and you can see obviously I have the limit up here. I was expecting to have woken up this morning and it had already ran up to that high, but given where it's at now, you'll actually watch me collapse it live. But the idea that we were looking for 77.25 is based on, number one, the bodies of the candles, because that's where the bulk of the volume is. Okay, so the algo will reach through, run up into this area of liquidity. Why? Because the bulk of the volume is here, so the majority of the stops are resting just above the big figure, 0.77. And because if we expect a run on a big figure number that has not been penetrated in recent times, we expect price to run through that at least 20 pips generally. So if we go down to a 15-minute time frame, okay, you can see the market was finding support inside of bullish order blocks. Bullish order blocks are the down candles right before the market moves through a short-term high. That's how you qualify a good bullish order block. It has to be in a kill zone, and this was obviously during a time when the market would be sensitive for the Australian dollar. And the initial stop loss was just below the bodies of these candles. Okay, and as the market moved up a little bit before I went to sleep last night, I'd move the stop up just below these lows here. If it was good, it wouldn't come back down here. It would expand and at least run for these stops. Once it hits that, it's going to reach for the 77 big figure and then run for the 77.25 level. Okay, so I'm going to collapse the trade here so you guys can see it and I can talk freely about everything. Okay, so the idea we use for liquidity runs, that's the basis of all the setups that you're learning over the next 12 months. If you're focusing just on entries, and I've said this many times before, if you're focusing just on entries or entry patterns or entry techniques, that's the least of your concern. That's the least important factor, because actually you can be a little late or a little bit early as long as you know where the most likely liquidity is going to be reached for. Okay, so at the interbank level, the algos that run and deliver price to us, they're going to seek where the majority of the liquidity is. And obviously, if you look at what we've seen for the Australian dollar, let's go out to an hourly chart. Okay. Aussie had caught a bid for a while since the last day of August, and every bullish order block has been capitalized. We had this one in here, and that's what we expanded out of from the report last night. So the market structure has been in place for bullishness. We talked about the Australian dollar and even the Kiwi, which, just for completeness, I haven't talked about Kiwi for a while, but let's put it up here for a minute, because both Kiwi and Aussie, they do have interest rate driven markets for higher prices, and you can see that's been the case, and it's still been going higher. Okay, so and you can recall that from all the YouTube live sessions I did the notations that I gave for that. And I think I don't recall exactly what webinar I did, but I pulled up the interest rates for all the major countries and showed you the relationship between all of them and how to get that information. And Kiwi had the highest, and then Australian had the second highest in terms of the interest rates. That builds in a carry trade idea. So you have all this market action to support those quote-unquote fundamental drivers long term. All right, so David, check the Twitter. We were talking about the Australian dollar last night, right around the 9:30 time in New York. So wherever you're at globally, figure out that time on Twitter, on the feed, and you'll see that we were talking about 77.25 is the liquidity run. So if you haven't caught wind of the theme that we've had for the entire month of September so far, is I'm proving, number one, on a daily basis that we can call the direction on intraday volatility. We can call where the market's going to reach for with a high degree of consistency. Well, it's not going to go. It's not going to go to 77.25 or 50 pips or so in a big jump unless it's impact driven. But we were joking about that on Twitter last night, how it was no real fireworks. It was just like nothing happened. So nonetheless, the liquidity is still at 77.25, and it layers all the way up to 77.50, which is the reason why you saw the limit where it was. All right, so again, going through every single day, I'm giving you context about what market we're watching or studying for that particular day, and we're waiting for the market to expand either higher or lower into the liquidity that we know. Every single day, we're getting those responses in one capacity or another, one currency or another, we're getting it. So I'm hopefully communicating the fact that while it's not necessary for you to take a trade every single day, and it's not what I'm trying to cultivate in your expectations, I don't want you to see every single day us finding opportunities like this where the market will reach for certain levels and then running away with the idea that I should have been on that trade. Okay? The month of September is, number one, calming all the nerves, because there's a lot of people that have uncertainty about, number one, me, two, the ability of anyone being able to consistently call the market. So we're spending the entire month of September just laying the foundation, proving that there is a method behind the madness that price is delivered on. It's not random. We've proven that just about every single day so far. I think that the level of consistency and the focus that we have relating to specific currencies and levels that we call for, and it hits that, that is the beginning blocks of you developing consistent trade entries and setups. If you don't have this idea, it doesn't matter what your entry pattern is, because it's probably going to be wrong. If you can't determine where the market's most likely going to reach for, I mean, can we all agree that if you don't know where it's going, does it matter really when you're buying or selling? Because if you have the direction or where it's ultimately going to be drawn to, it doesn't make a difference. Entry patterns are the least important, because if you don't know where it's most likely going to go, you might as well just throw a dart and see what happens. You have to have a clear indication where the probabilities most favor the market going higher or lower, and not just vaguely higher or lower. To what level is it going to? There's specific prices that the algos will reach for, okay? And when you understand the framework, you'll know exactly what to reach for. You'll know what to look for in terms of the price action. And then between where the market is at the time of your study and where you anticipate that market reaching for that liquidity, inside of those two price points, there's your trade idea. So then you wait for the specific price pattern that you trade on, whether it be a bullish order block or a bearish order block, return to fair value where it closes in a range, or a stop run, turtle soup. Those three conditions is all you need, but you have to understand the context of what you're looking at and frame the idea of, okay, right now the market is at XYZ price, okay, and indications are in the chart that the market will most likely want to reach for the liquidity above this level. And how many pips away is that? If it's not a favorable amount of pips, and to me, I like 50 to 75 pips. If I can't get a trade that does not warrant at least 50 to 75 pips, I'm really not in it. I'm not interested in taking it because it's not going to give me the the return on my time and energy invested in monitoring and managing it. For some of you, that's probably still not enough. You probably would want several hundred pips, and you're going to have to use time frames like the 4-hour and the daily to find those trades. That's fine, but there's a million opportunities across the month with all the different pairs that are available. All you need to do is just settle down and just pick one pair and focus. We did the Canadian dollar yesterday. We did the Australian dollar last night. We're going to be focusing on the impact of multiple reports coming out during a New York session. So that's the focus for today. We're hopefully going to showcase how the markets will gyrate between two decisions. That's most likely what we're going to see in New York today. So that's going to be the framework of study for today. But hang on a second. CV, yes, the teachings will, that's the goal. That's what we're doing for the next 12 months. But what I'm encountering as a mentor and a content provider is everyone that's subscribing is unrealistically expecting to understand it in the first week. And I, like I said before, I appreciate your ambition and I appreciate your enthusiasm, but you got to dial back your expectations. Okay, it's going to take some time for you to learn this stuff over periods of time. Okay, trust me. The main thing is you're learning from somebody that knows what they're doing, and that's all I'm trying to communicate for the first month. Because if I don't know what I'm talking about, you would have known by now. I would have been falling on my face every single day, and we're seeing consistency. Okay, so I want to focus there, and that's the first thing I do when I teach individuals is, number one, prove that the markets are not random. You have to be able to do this on a consistent basis and not worry about the money. Don't worry about taking the trades. Don't worry about the setups. You have to have the ability to sit on your hands and just allow price to move, and you evaluate, you monitor, you learn, you digest what the market's doing, because it develops a pattern of recognition that you will see repeating over and over again. It doesn't matter what pair it is. It's specific to how price is delivered. From the interbank level, when these prices reach us, it's not just, well, it happened because of this or that. No, it's happening because it's going where the money is. The money is, well, for instance, let's go back to the Aldi. All the money was resting right above the big figure 0.77. And we know that they usually will sweep about 20 pips above the big figure because it hadn't been to 77 big figure yet. So once it gets to the big figure here, it will want to reach and expand through that. That odds of happening increases when we know that there's an old high back here and bearish order block, which is this up candle right for this big sharp move down. So we have a layer of stops in here. We have a 20 level right above 0.77, and we have a bearish order block. And the market was consolidating, or as we teach it, crouching just below a order block. So the market's going to do what? It's going to expand. Why would we expect it to expand on the upside? Because of the down candle here, the market willing to break up through a short-term high. So market structure's bullish. It comes back and stays inside the bullish order block, which is this down candle right in here. Let me zoom in for you guys. The down candle in here, and we know that order blocks are bullish when it's a down candle right before a move up, and the most bullish sensitive aspects of a down candle, which we classify as a bullish order block, is from the high to the midpoint of the candle. Okay, or the body of the candle rather. Right there. Okay, equilibrium. I probably have to zoom in a little bit more. So we're measuring the body of the candles open to close, not the wicks. We're not concerned about the wicks because the wicks are all going to be different across all data providers. So your platform is going to have a different low, and just to prove it, just for for this candle here on September 7th, okay, the low comes in at 76.51. So yesterday, on your on your Aussie dollar hourly chart, what was the low on this candle for you? And again, mine is 76.51. So far I'm getting 76.50, 503, 63.8, 650, 651.2. See, that's what I'm saying. You're going to get a disparity with the actual high and the actual low. And I see 76.49. So there's a lot of disparity between the actual lows. The reason why I'm telling you all to use the same demo account to teach in is because you'll all have the same reference points. You'll have the same exact highs and lows, and it will remove all the confusion about, well, my chart says this or my chart says that. You're going to have to trade on the charts that you are given, but the context and the concepts will all still be the same. You're not worrying about the low when you're buying a bullish order block. You're focused primarily on the middle of the body of the candle to the top of the candle in the form of its open. Okay, so in this whole range here, okay, this is the most sensitive price point. If you have a small little wick, you can use that. But generally, I just go right for the body anyway. And you can see equilibrium is just about kept everything at bay. I mean, you can see the low here, and just went below by 1 pip right here. But look at the bodies of the candles. It's not allowed, it's not permitted to go beneath half of that candle. I'm telling you, for those that are foolish and they think that the idea of a interbank algo is contrived, made up, or whatever, every single day for the week, to last week, okay, a little bit more than a week now, for folks that signed up, we have been calling very specific levels with directional bias, and they're unfolding every single day. That does not happen with luck. It doesn't happen with harmonic patterns. It doesn't happen with technical stuff that you learn in books. I'm showing the repeating phenomenon of how these prices are delivered to us. They're not based on anything except for where the money is, and that's going to be in the form of liquidity, either in pending orders, okay, or hard stops. That's the market. That's how it operates. It's moving and gyrating between two reference points. Who wants to get out and who wants to get in? And based on what the book is made on at the bank, the market makers are going to drive price to those levels because it's going to pay them. Transactions are going to happen all throughout the day, but the profit side of making their book will be running liquidity that's existing in the marketplace. And by understanding the repeating clues that the market gives us, and you're not going to learn it in the first month, it's going to take a couple months as we go along, and suddenly you'll see about midway you'll have a level of knowing pretty much what I'm going to talk about, and then you'll be very confident about what we're learning. And then we get into the 7th month, you will all be in new uncharted waters, because it'll be new concepts and new amplifications about things I haven't talked about before. But for some of you that went through the pre-tutorial section, you still struggle with a lot of things because you're trying to apply every single thing I teach. But all those things are necessary to understand the greater whole, but only a few things are needed to trade around a specific idea. But the first thing you need to know is understanding where liquidity is in the marketplace and which side of the market is most likely going to be hit. Because if you get that out of the way, number one, what does it answer? Does it not give you directional bias by default? That's a question, by the way. Exactly. So if you have a way of determining a level of liquidity above the marketplace or below the marketplace, you're not focusing on direction. You're not focusing on, should I be a buyer or seller? You're focusing on, where is the money? Where is the money at risk right now? Where are the market makers? If their book is profitable, okay, right now it's going to be even more profitable, or they'll be able to book their gains if the market goes to what level in relationship to where the market has been. The longest term price moves are where the smart money is going to be, already positioned. And they're going to see these positions move in the last stages to get to their ultimate profit objective. And what I mean by that is this. The market makers have already booked long positions here. They recapitalized longs on this down candle right over here. Okay, it run again, and they bought more in this down candle here. Why? Because you can see the price moving away. Okay, these two candles together, even though it has a lot of wicks in here, this is all a one. This is one order block. Okay, I don't have the capacity to show a 2-hour chart, but if it was able to show 2 hours, this hourly and this hourly candle together would make a 2-hour down candle. The top of that candle comes in at 75.77. The low on this is 75.75. So it went 2 pips into this 2 down candle move right before the big move up. So they recapitalized buying here. They recapitalized buying in this order block again. Expands. So you can see the willingness on the part of the market makers to keep adding new buys every time it comes back to a fair value or a discount, which is what we're going to teach you about, or what I'm going to teach you rather, in the month of September. So I'm going to teach you what discount is relationship to equilibrium, what premium is in relationship to equilibrium, and what that means for you in terms of determining where liquidity is. So I've given you a theme for September of knowing, or at least exercising the ability and showing my prowess to do it every single day to show you where the market is most likely going to reach to. And again, not just any old direction, because it's not enough for me to go in here and say, I think pound yen's going to go up today. It's not enough to do that. If I've been really versed in knowing what I'm doing, I'm going to tell you, okay, if it's going to go up, what level is it going to go up to? If I'm going to say a market's going to go lower, it's not enough for someone to say it's going to go lower, and you should be satisfied with that. I wouldn't be satisfied with that. I mean, you're paying me now, so you need to know that what you're learning and who you're learning from, they have the ability to do this. It's not just demo balling, okay? You have to understand specifics about where the market's going to be going higher or lower, and then have a context around why you believe that. So for me to be able to communicate that over weeks in the month of September, number one, I have to give you examples of it, not just once or twice and be lucky about it. It has to be consistent. And every single day we've been consistently calling specific levels across numerous pairs. It's not just been my pet pairs, cable and fiber. We've used Australian dollar today or last night, and we used Canadian dollar yesterday. So I'm showing you that it's not limited in scope to my pet peeves about what markets I want to be in, what markets I don't want to be in. They're universal applications because prices delivered from the central bank. And if you understand what they're doing, okay, it repeats over and over again. Now, that does not mean that you won't mistakenly see something or read into it and make the wrong decision. That's where your losses are going to come. But you're going to learn over the next 12 months what conditions frame high probability conditions for the setup. If you get those conditions and you develop a skill, what we're teaching for the month of September, you will have everything that you need to be a consistently, independently thinking trader, completely isolated from everyone else's influence. You won't care about what the people say on the forum. You don't care about what everybody else's system is. You won't ask me what I think. You won't even concern yourself with me anymore. You'll know exactly what you're looking for, and you won't rely on any other outside influences. Hang on one second. Okay. So the idea of looking for liquidity and then understanding range expansion, okay, these are all concepts that you're going to be getting in specific teachings. So again, I'm just reminding you, folks are still asking me where's the PDFs and where's the teachings at, and where are the videos. Those are delivered on Saturdays. So you get 2 each week, 8 for a total every single month, but you only get them delivered to you on the forum in the form of a link and with the PDF files on Saturday. So Saturday You'll have 2 teachings. I already told you in the previous recordings what that schedule is for this week. I'm sorry, for this month, and what teachings you're going to get. But I'm not force feeding you 1,000 things a month. I'm giving you 8 specific lessons, 2 focal points each week. So that way you'll be able to easily digest things. You're not going to be inundated with information. The daily application is just us proving the concepts work over and over and over again. And believe me, I know some of you are excited and you feel like you're missing 1,000 things because you can't come to the live event and you're watching it and recording. It's the same concept. Just look at your charts and you'll see that everything we're talking about here, you can see it in hindsight. It's no different. The only thing we're talking about is we're doing it live and giving you explanations with a deeper understanding of what it is that should take place. You'll learn all those things that you see me doing through the teachings. That's what the aim is for that. So I'm teaching in the specific teachings the concepts and theory. Every single day of the month, I'm actually applying those concepts in the charts. So you can see it, it repeats. There's no reason for you to get upset. It's not like it's going to stop working in October. Okay, so believe me, everything that I'm showing you works, and it's been working for years, and it's never going to stop working. Stop worrying about missing opportunities. There's so many. Every day there's a new opportunity. So don't worry. Don't feel like you've missed anything. Okay, the markets are still going to be trading in October. And going further beyond that too. So just relax and settle down. Believe me, I know what it feels like to be a new trader, learning new exciting things, but this isn't going to go out of style. This is how the banks work. This is how the price is delivered. They're not going to change their method, not because I'm putting it out there. None of that. That's how it operates. You're not going to change it, okay, by me giving 700 people the keys to the kingdom. That's not going to do it. Believe me. There's so much money out there, and they're only attacking the fund level traders. They can't even see us because we're not out there in a retail account. So that's enough of that. So let's take a real quick look at cable and fiber, and then dollar, and then we'll close it. We'll come back a little bit right before 8 o'clock. So we're going to be watching the effects of euro first with our economic calendar. Okay, so we had euro dollar run up. We were looking for a little bit more of this happening yesterday when we were running for a run above these highs in here. Let's go out to a daily. Okay, and we looked for a couple different things. We were looking for on the daily chart the liquidity pool that rests above these highs here for the buy side of the marketplace. We were contending with this bearish order block here, the sell side, and we presently have nothing in here. Nothing in here shows any concern for, at least for the near term, for the bulls. We have no real liquidity voids. It's been rather systematic in the way it's closed in all of its ranges. Like the 2 candles down here, it closed all that and went above it. On this candle, this range from this down candle into this one, that entire range has been absorbed. We closed in this. We breached the bearish order block here, this up candle right for this down move. So we are in bullish territory. So we were probably going to see another expansion for euro dollar intraday. Dollar looks like it's going to run for our liquidity pool below here. Yesterday gave us a small little bounce. We were concerned about these layered bullish order blocks, which is why we saw what we saw yesterday. It did trade up inside of the range identified. I'm not sure if I still have that chart. Don't believe I do. No, I don't. Let me double check this one. No, I don't. But I shared it on Twitter. You guys can see that on the Twitter feed. All right, so let's take a look at euro dollar. I'm sorry, cable real quick because we got to go back to fiber and watch the Yeah, cable's a mess. Look at that. Yeah, I don't like the idea of. So I think selling this one's a bad idea. I just think that they're just going to run it higher. I just don't trust it. And like I said, I've admitted for weeks now, the condition after Brexit for cable is a learning environment for me, even because this is new territory for me, trading in a condition after something like that. So I've been very reserved in my exposure to cable, both in the leverage that I use if I do take a trade. It would be 5 to 1 at most, not 50 to 1, which is allowed in the States. All right, so let's go over to the euro dollar. Okay, and real quick, today's macroeconomic calendar. Okay, so we have the minimum bid rate coming out in about 8 minutes. I'll explain why I have the opinion that cable's a mess after we come back on our second session. Right now, we're just looking at the effects of the minimum bid rate for euro. All right, so we have liquidity above 113.75, so in the form of 113.80. Good grief. Always someone texting. 113.80, we have buy stops above it. We have liquidity in the form of sell stops at 111.40. We've avoided 111.75 to 111.70. And we have small little liquidity pool resting below here. Okay. And what you're going to do is you're going to watch and see. It has a high impact weight to the news event that's coming out here in a couple minutes, about 4 minutes. We had a void in here, liquidity void, which is a quick rundown in price. It can be a quick up run in price, but we have all this range. It's been recently just closed in. Right in here, it's closed it in. And the market makers buy in consolidations and they sell in consolidations. So we have a range in here. The market expanded, come back down, recapitalize these bullish order blocks, which is the down candles that we saw here. The market expanded one more time, we consolidated, expanded it again. We closed in this range. Outside of this run here, there's been no run on liquidity above the highs. So what does that mean? We have stops above here, we have stops above here, and we have the old high referencing the 113.75 113.66 level. So we got 113.70 to 113.80 big figure on the upside. And we have a small liquidity pool right below here. If we lose ground and drops down, if it just takes below this low here and then trades back above this level, it will run for this level here, 113.70. If we lose this low and come all the way down to here, we'll watch and see if it has a willingness to bounce there and come back off of that and make another run for this level. So what we're doing is we're watching to see which one of these levels is going to have the most sensitivity. Right now it's heavily weighted for the run up here. Good morning, Mike. How are you? They can. Tanner's asking why wouldn't they just wait for it to drop down here and then rebuy. They can, but we've already left this area down here. So this range expansion here, this impulse move, left a measure of equilibrium in the range. So now they've already shown a willingness to want to go above and reach for upper levels. And outside of just closing in this void, nothing's really happened on the upside as far as running stops. So liquidity's still in jeopardy above the highs. And what we're going to do is we're going to weigh the effects of this report release, and then we have others coming out at 8:30 that's dollar-based, which may be what the euro dollar waits for ultimately for New York. So I'm showing you the effects of when you look at the economic calendar, like we've been talking about the last week. We frame our ideas in advance based on high-impact news. So when you have these high-impact news releases, either in the form of high-impact or medium impact, okay, specifically dealing with the high-impact ones first and foremost, they're going to take precedence. By having those first and foremost in your mind, you can look well into the future and see where those reports are going to be released and relative to when they are being released and what kill zone they're in, whether it be the London Open or the New York kill zone. They'll give you context to work within and plan your trades. You can plan the idea of being involved with the marketplace around specific currencies based on these news events, because the news events are going to be what? What do market makers use news releases for? What are they? They're injections of volatility. Now that volatility, what's it do? What's the purpose of that high volatility? What's it seeking? Exactly, liquidity. So we'll know that there's going to be a manipulation that takes place around that release time. Now again, I don't concern myself with the actual raw numbers because it could mean anything. It doesn't have to be a bullish or bearish number relative to the historical aspects of what that report should indicate. In other words, if you go to like Forex Factory, I like their calendar because I just like it. I'm used to using it for years. But the point is we as traders are not concerned about the raw data because that raw data has already been priced in the marketplace by those individuals that use this information. We don't use it. It's already factored in. So our concern is really what's the impact after that market news hits the marketplace. And our understanding is it's used to inject liquidity in the marketplace in the form of high volatility. So there's going to be a lot of movement around this specific time of the day. It's going to be a lot of gyrations. It's going to reach for where the money is in one of two reasons. One, to knock those individuals out that are properly positioned that will eventually be profitable. And if they can knock those individuals out of their profitable positions, they will assume their position by knocking them out. Or the other one, is to put them in on the wrong side of the marketplace. And that takes a couple months with me to understand what that means, how that looks in charts, and how to set the context up for your trading ideas relative to each individual um, condition for each report and the current conditions and price. Brandon asks, do I usually only trade on high impact news, like how you didn't trade on an open? Uh, you'll learn by being with me on a daily basis that the majority of my trades will be around a London Open that has usually one high impact news event, either on cable or fiber, because they're the pairs I like. But we won't just limit ourselves to that, but we'll trade other pairs in other kill zones like we did last night with Aussie. We're going to do a lot of work in New York because I want you to understand how New York is so easy to use for your trading. Hang on one second. Because you have the benefit of having had London price in the daily high or low. So for folks that are, even the folks that live in London that are really globally positioned for ease of access to London times the trade, even for those individuals, I think that trading New York initially as you're developing is still the best way to go because you have a built-in advantage. You already have what's already priced in for the high or low on London. So you sit back and you just let London do whatever it's going to do. Because if you're not really astute as to what you should expect to see in price, London can burn you bad, real bad. But New York, it's just like you just wait between 7 o'clock in the morning and 8:30. There's your setup. It's usually just like that. Every single day, there's something that you can trade in that session. And if you just wait around and lose I had to have every bit of the daily range. If I don't get every bit of the daily range, I'm not successful. If you're nailing down 30, 40 pips every single time you sit in front of the New York session, who's going to complain about that? I mean, some of you folks, probably haven't seen that measure of consistency just for one trade per week. And to be able to have multiple sessions throughout the week, to be able to sit down and draw and harvest that consistent amount of pips, think about it. If you could pull out 25 to 30 pips just twice a week, is that better than you're doing right now? I mean, for some of you, it's probably not better. I mean, but for the newer crowd that's in here that's trying to learn how to do this, I mean, if you had 60 pips or so, okay, over the course of two trades, two trading days, and you had a net of 60 pips, if you consistently did that week after week, come on. I mean, if you don't understand the importance of having consistency in a low end objective like that, because that's not hard. 60 pips in the course of a week is very easy. You have no idea what you can do with that. That's what month 2 does. We're going to teach how compounding with even a small account, the amount of money that you can grow even with a small account. It's not important having a lot of money. What's important is consistency and delivering that in your trading. Hang on one second, I gotta get a drink. Sorry about that, guys. My wife's sending off my one of my children. I have to give him a kiss and wish him well for today. So, in my upcoming teachings, am I teaching commodities and options? Yeah, I'm teaching all that stuff. This mentorship, you get to learn everything that I know and everything that I was going to teach at the spring session. There's just no way, and talking with Chris Laurie, there's just no way I was going to be able to teach everything I'm willing to teach in a 3 or 4 day event. It's just, it can't happen. It would not happen. It would not be able to happen. It's too much. So, no, I don't know. Chris doesn't know this. Some of the things he teaches, is close to what I do, but I think if you were to ask in open forum setting like on Twitter, ask individuals that have had exposure with Chris Laurie. Now, again, I'm saying this with a great deal of respect because he's the only one I like as a teacher in the foreign exchange realm. But I think if you were able to ask people, and if you asked them through my Twitter feed, ICT_M Huddleston, you'd get some feedback because generally everyone that has gone through Chris Laurie and found me later on, they said it was different. I'll just say it like that. I'll talk more about why I elected to go to this medium on another time. I just don't want to take too much time with this and make the video just chit chat. I want them to be focused. Yeah, no, that's what I'm saying. Scott, exactly what I just said. So what we're looking at is a wait for 8:30's news. And again, let's go back to the calendar real quick and recap what that's going to be. $8:30, we have Canadian dollar building permits, and then we have the ECB press conference and unemployment claims for the dollar. So 8:30 should be a volatile time for the marketplace. So we're going to watch and see what we get in terms of a liquidity run on that, and then we'll have a break around 9 o'clock, between 9 o'clock to 10:45, and 10:45 I'll come back on again and we'll watch Canadian dollar for the crude oil inventories release at 11 a.m. So like I said, there's going to be 3 sessions today, and we'll break for this one now. I'll come back in about 20 minutes. I need to get something in my stomach, and then I will outline what we should see for Canadian dollar and euro based on that. Okay, guys, I'm going to close this one here. All the recordings will be made after we are done the 11 o'clock session. That way I can put it all on one post and it's all handled. Okay? Yeah, everything will be linked to you through Twitter. You have to follow Twitter to get the links as soon as I get the events ready. And also, as I'm sharing charts, you need to be able to access that information. The forum password is capital E NIGMA number 9, Enigma 9, Enigma 9. All right, folks, I'll see you in a couple minutes. Thanks.